Okay, that's okay. That's fine. You can hear me okay, though?
Debbie Marcoux is licensed by the Department of Financial Protection and
Okay,
Innovation under the
no
California
problem.
Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick
Just
up the
barely.
phone
If
and
I didn't know they
call
were dogs, I wouldn't
mom.
know. I got mine laying right here too.
All right, so welcome to Mortgage Mom Radio. I am Debbie Marcoux. I am the Mortgage Mom. And today I have got George Hartman on with me. George is a credit repair expert, but also an expert just in all things credit. And since it is 2024, we're thinking, hey, new year, new credit. Let's talk some tips and tricks, things that you can do to improve your credit score. The higher that the credit score is, the better that the interest rate is, the more loan programs that it opens you up to, the more options that you have, lower down payments are an option. So credit is just one of those things that are just so important. So George, thank you so much for being here with me today. I know you've done this show before. Many of my listeners have heard you talk in the past, but I liked the idea. You came to me and you said, hey, you want to do a credit show again? You know, it's the beginning of the year. And I thought, you know what? Yeah, we have been busier in the last 30 to 45 days than we were in all of 2023. So people are definitely revisiting the idea of purchasing homes, refinancing, trying to help, get the credit paid off, get the debts paid off, pulling cash out of their home. And so now would be the best time for them if that is a goal in 2024, which it seems like that is another big spark again this year to get that credit under control. So once again, thank you so much for joining me. I appreciate you being here. And I want to remind everybody that if you have questions for George, you want to talk about credit, please feel free to put that question into the chat. I will read it out loud. George can't see it, but I can. So I'll read it out loud and then George can answer it for us. And when Manny has 2 minutes, he is going to try to fix it so that I can see those comments because right now I can only see George, but we're going to get that fixed. So go ahead and just start throwing them into the feed and we will read them out loud and answer them. If you're here and you're enjoying the show, you're on with us live, give us a big hi, a thumbs up, let everybody know that you're here as well. So George, like I said, thank you so much. I know I've been rambling, but I love that you brought this up for us today. So let's talk a little bit about, are there any changes to credit reports, anything the credit bureaus have come out with, anything that you've seen recently that was not there before, was not a rule before? Is there anything that we need to know updated?
Again, thank you for having me. I can't believe we've been working together for over a decade. It's
I
been
know.
over a decade. And yes, coming here at the beginning of the year, because it is such a big resolution for people, to take control of their credit, to be educated about credit, to learn everything that there is to be in control of your own credit. And that's been really the focus for me over the last, especially rolling into this year, is I have clients now that are coming to me that have no negative credit, but they don't understand their credit and they are paying me just for the education
Yeah.
because nobody's teaching it. Nobody's teaching their kids, and they're able to take that information and teach it to their kids. But as far as anything really new for this year, nothing that's really on the top of the agenda, since the medical thing came out and, removing some of those smaller medical collections and things like that. But everything's pretty status quo as far as, the process of going through fixing up your credit and mastering your credit.
That's awesome. So I do want to say that I can see that Joe Vera has jumped on. He says, woohoo, love this show. So Joe, thank you so much for joining and being a part of it. I've seen you on here before. So those return watchers and listeners, we can't thank you guys enough. For whatever reason, because we're doing this more of a Zoom, I'm not able to see the chat that would be coming in also from Facebook. So if you are watching me on Facebook and I am ignoring you today, I'm not doing it on purpose. I can only see the chat that's coming through from YouTube. So I do apologize for those Facebook watchers. But Joe, thank you so much for jumping on and saying hi. Carrie did jump on as well and says, hi, Debbie. Hi, George. So that's our Carrie from the team. Love Carrie. And then Michael Manriquez jumps on and says hello. So Michael, so great to see you too. I know you jump on the show quite often to watch and really do appreciate that support. So again, if you guys are out there, you're watching, this is interactive. George is going to give us answers to any questions that you might have whatsoever about credit, which I absolutely love. And remember that it is 2024. We are rounding out the very first month. I cannot believe that we are almost at the end of January already. But this is the beginning of the year, and there's a lot of people that have a goal to refinance their home or purchase a new home, maybe sell their home and buy new, moving up or moving down. Things have been put on hold for, most of 22 and 23. So now we're in 24. Interest rates are coming down. That window of opportunity is opening, which is fabulous. And so there are a lot of people that are about ready to start getting that piece going. And again, the higher that the credit score, the better the interest rate, the more loan programs available, the lower down payment options available. So all of that is really important. So I love that you're here. So nothing new as far as actual rules, from the credit bureaus. No major changes. If you don't make a payment, it's going to show up on your credit report. if your collection account is over. So let's go over that for a second. I think it's good that you actually brought that up. We haven't talked about it in a minute. So with medical collections, what is the number that the collection dollar amount has to be over before it would actually hit the credit report?
It's $500 now. So anything $500 and less will not go on the credit report as a collection. And if it is there, we can typically get that, I hate to say easily removed, because typically nothing's easily removed, but typically those are coming off now. But if it's over 500 on the medical, and then, to touch on the late payments, a late payment there's only really a couple of things people need to know once they have their credit mastered. And one of the key components to building a long-term super high credit score, like to get back into the 800s, is a history of on-time payments. Now, what I mean by on-time payments is even up to, 29 days late, as long as you don't go 30 days late, and that's not going to show up on your credit report, but you will pay the fee. So you don't want to get into that habit of making it late. However, those on-time payments, if you make a late payment, it could hurt you by, it could be 60 to 100 points. It's really insane the way that it works, because that will affect you for 24 months. It takes a full 24 months to recover from a 30-day late payment. And let me tell you, in the almost dozen years I've been doing this, it's one of the hardest reversals to get.
Yeah, the removal of a late payment.
My last late payment, believe it or not, I was my first client. So anything that I'm taking all of our clients through over all these years is the same path that I walked myself. And after I had my credit back up into 730, I think it was, I got a late payment from a fee on one of my credit cards. So the monthly fee, I forgot to make the little $6 fee to keep the credit card open, and I got a 30-day late from that. And so I got a 30-day late from something I didn't even purchase or a balance I didn't carry. And it took me like 17 months to get it removed. It would have been out of my system in 24 months, but it took me 17 months to get that removed from a little tiny $6 fee. So it's really, really important.
Yeah, it's definitely one of the most important things you could possibly do is continue to make those payments and make them on time. I can see that Annette jumps on. Annette, thank you so much for joining the show. And she says, is getting a personal loan to pay off credit card debts will that affect me getting a home loan within the next 6 months? So this is actually kind of, I think, a good two-part question. I'm going to answer her question, then I'm going to let you talk about the debt consolidation loan and how that's going to change your credit score. But it will actually not change you getting a home loan within the next 6 months. What we have to take into account is what the monthly payment is on the new personal loan. That is going to go into you qualifying your debt to income ratio. However, if you have credit cards right now that you're consolidating into that loan, most of the time, the minimum monthly payments that you're already making on those credit cards are going to be about the same as what that personal loan payment will be. So it's probably not going to make or break a whole big difference, but definitely something that when I tell you guys that if you're thinking about buying something this year in 2024, I was actually saying last year in 2023 that it was a good time to start reaching out and getting that consultation with my team started right away. The reason for that is that we're going to go through things with you, not necessarily start your pre-approval or not necessarily, start pulling credit or gathering documents, but just that initial consultation is going to be a phone conversation of what is your income? How much are those minimum monthly payments on those credit cards? Okay, you're thinking about getting that personal loan. How much is that monthly payment do you believe that that's going to be, on a monthly basis to pay those credit cards off? And we're going to do those numbers by hand to determine if the debt to income ratio would be better with or without that personal loan. But now I'm going to let George jump in and talk about what that personal loan is going to actually do to your credit report, because I personally like the idea, but George, you jump in.
Yeah, I mean, it depends. I'm not a huge fan of debt consolidation as a practice, and I don't believe it does somebody the best good, because the cards end up being charged off anyway, and it's something that people can do on their own if they're going to choose that direction, and I can definitely guide them in that direction.
So you're talking about like the debt consolidation, like those debt relief programs, or you're talking, no, so that's not what she's talking about. She's talking about taking a personal loan to pay all the credit cards off. So good credit, keeping good credit, having a monthly payment, credit cards at zero balances.
Correct. Yeah. So sorry to get sidetracked on that
Yeah.
that point. I just wanted to make the point about those type things. Now, a personal loan, typically what's going to end up happening, because of the length of the loan, the payment's going to end up being less overall than all of your different monthly payments that you were making before. So you will have a loan that will report to your credit report. The payment on that, again, as you mentioned, will go into the DTI. So as long as that's not affecting their qualification, then I believe that they're going to pay a whole lot less interest going with a personal loan and keeping those credit cards paid off. Also, because credit cards and the management of credit card balances and revolving debt equals 30 to 35% of your credit score, now all that balance that was on those credit cards comes off of there, and the credit scores are typically, you might see a little drop because of the inquiry in the new account, but typically because of the lower balance on the credit cards, or the credit cards being paid off, which is that's the sweet spot, right? You save the most amount of money and you maximize your credit scores when your credit cards are at zero balance. So it's definitely a positive thing if you can get the right personal loan.
Yes. So what we typically see is when somebody does take a personal loan to pay off those credit card debts, we see their credit score actually jump quite significantly. The same thing that we see if somebody takes a home equity line of credit to pay off debts, or even a home equity loan to pay off debts, we'll usually see their credit scores spike. Now, like George said, you're going to see that initial dip. What I typically see is that you've had your credit report pulled to get approved for the loan, but the 30 days that it takes, the trailing part of getting the credit cards paid off, and then those reflecting on the credit report, you might see a small dip in your credit score for maybe about 30 days or so, but then we actually see those credit scores spike. So what I did like that George said, which was I think that I need to drive this point home to my listeners, is it is not a good habit to get in taking a personal loan to pay the credit card debts off. So if you are taking a personal loan, paying off those credit card debts, and then going to go back and respend and use all those credit cards again and just bring them right back up to where they were before. Maybe you just need to try to manage the ones you've got and try to work really hard to get them paid down, because it's just a vicious cycle. You're just going to owe more and more and more money and have this loan that's outstanding. And then those credit cards, all of a sudden you owe them again. And then now you got to try to figure out how to get those credit cards paid off again, but you already still have this personal loan that's outstanding. So we want to make sure that you're doing this as a way to get out of debt, and that you're really super focused on all of my extra money is going to go towards this loan to pay this off. I am putting my credit cards in the drawer. I have one that I use when I go out because I don't want somebody to be able to steal my debit card number at the gas station, or wherever, grocery store. I've noticed every time I use a debit card anywhere, gas station, grocery store, Target, is when all of a sudden it seems like somebody's stolen my debit card number. So I use a credit card for safety reasons, but it's my credit card that I can pay off at the end of every month. And all of the rest of my credit cards are put away and they're sitting there and I'm not using them. That needs to be the mindset and the focus when you take that personal loan to pay those debts off, or else it's just that vicious cycle. So George, thank you for bringing that up. I think that's a really important piece for people to hear.
Yeah, your credit cards are one of those things, Debbie, that I have to trick myself. I mean, literally, I've gotten to the point, because it is a vicious cycle and it's so hard to get out of, that one of the things that I found over all these years and working with all these clients, and especially even myself, is it's an addiction now for me to have my credit cards at zero balance. I love it, but I've gotten disciplined in the point where when I start using a credit card, if it gets to a $500 balance, no matter where I'm at within my cycle or where I'm at with anything, I send a payment. Because $500 is something I'm used to. It's been my car payment, it's been, my RV payment, it's been a rent payment in the past. It's something I can deal with. When that balance gets to 800, I get a little squeamish, like, oh my God, $800, I got to get on top of this. And then unfortunately, here's what happens with most of us. If it hits $1,000, the next thing you know, guys, Friday night comes, you had a rough week and you and the wife are going out to dinner on the card. Money's a little tight this week, so we're going to use it to go to the grocery store, and we're going to pay it next week. And we get into all these justifications. And then the next thing you know, you turn around and you got $5,000 on a credit card.
Easy.
It's so difficult to get out of that.
Yes.
So it does become a discipline, and it's something that I coach people on, and it's just been a phenomenal thing to watch people become free of their credit card debt.
Absolutely. No, I love that. So what I do want to do, because I don't want to run out of time, this show, obviously, people that are watching right now we're doing this live. You guys are seeing us do it. You see me looking down at my phone because I'm trying to look at the comments that are coming in. I'm yelling at Manny. I'm putting my arm up in the air because I can hear the dog is crying. So I'm like, go put him away, put him inside so you guys can't hear the dog. So this is real time. But for my listeners that are on Saturday morning on Go Country 105, I want to make sure that we get through the 5 bullet points that you provided to me, because I said before we started the show, you know what? I really want to structure this out. I want to make sure we're giving my listeners 5 really good bullet points for things to keep in mind, things to do to make sure that they are keeping their credit score as high as possible. So we are going to take a super quick break. Run about a minute long commercial. It's going to be me talking about equity lines or something. And then when we come back, we're going to jump into these 5 bullet points, and then we'll keep talking. I can see that. And before we do that, Annette says life happens, and she was referring to what you were talking about. And you are right, Annette, it does. Heidi jumped on and says, hello all. Living my life in reverse says hello all. I love that name. And then Michael says, soft credit checks, ? What are those all about? What are they looking for, and do really have an impact on your credit score? So great question, Michael, because you see that a lot. People looking for, a new credit card or a personal loan, and it'll say, check what you're eligible for without any, ding to your credit. And it's just a soft credit pull. So before we take that commercial break, George, explain that. You want me to read it one more time?
No,
Okay.
definitely. It's one of the things that we're going to touch on again after the break, which is inquiries, because it's one of the 5, sections of your credit report that affect your credit. And so there's hard and soft inquiries. The hard inquiries are the ones that are going to affect your credit score with a few points each time you have it run, and they do watch. And the less you can have that hard pull, the better your credit's going to be over time. And a soft pull is like your online companies, like Experian.com or Credit Karma, or where you, the consumer, are checking your scores, or you're getting your insurance through one of the credit protection ones. Now, I say the easiest way to determine a hard pull or a soft pull, or when you should question it, is if you are going to receive something tangible by them running your credit, typically it's going to be a hard pull.
Yes, I agree with that. Now, they will say soft inquiry in order to find out what you're qualified for. So when you do see that, that is what they're doing basically is kind of like a pre-qualification. They're going to get a quick score from the credit bureau that would not be a hard inquiry, and then they're going to determine based on that credit score what are they going to offer to you. That doesn't always mean you're going to get that offer, and they are still, if you decide to move forward with the lending that they're offering, they are still going to end up doing a hard inquiry prior to giving you the approval for that loan or for that product or for whatever that is that you're applying for. But if it does say soft inquiry, it is not going to change your credit score. It will not show up on the credit report when other lenders run it. It won't be there as one of the people that pulled it. Now, you might see it if you have like Experian that's monitoring your credit report. It might actually come up that somebody did a soft inquiry, but it will actually be specific of what it was. You will know if it is a hard inquiry, but even if it's offering you the soft, if you move forward with what they're giving you in an offer, you are still going to end up with that hard inquiry. They have to do it. So, all right. I love that, George. Thank you so much. So let's all, don't go anywhere, 60 seconds. And when we get back, we're going to get into our bullet points of what you guys need to know. So stay tuned. We'll be right back. Okay. So what is the difference between a home equity loan and a home equity line? So we're going to talk about this on this quick value series today. So home equity loan,
22,
to make it very simple, is a principal and interest payment that is based on a term. So it's very similar to your mortgage payment, very similar to a car payment or a personal loan. They're going to take the whole balance and they're going to amortize it over whatever term you choose. And that is the monthly payment that you're going to make with a fixed interest rate. I love this option for somebody that does not have the cash to pay back in big chunks and pay things off quickly and fast. So if you're in debt and you're paying debt off, you're debt consolidating with your home equity loan, it's a great option for you. Now, what's a home equity line of credit? A home equity line of credit is basically like a credit card. It is simply that. It is a line of credit that you can choose to borrow. You're going to make an interest-only monthly payment. So the payment that you make will not pay the debt off, and it is open for a certain period of time, typically 10 years, before you have to get it paid off in full. And the monthly payment, the rate is adjustable. So if you are somebody that likes to flip homes and you're looking for cash to be able to buy that house that's in shambles that can't get financing, well, you might be a great person for a home equity line. You can use the equity in your home to purchase the house cash, do all of the renovations, sell the property to do that quick flip, pay that line of credit back off. But if you have a balance on that line and it's for a long period of time and that interest rate continues to go up, you're not making a payment that's paying it off, you're literally just on the same treadmill as your credit card. So is it good for debt consolidation? I don't personally think so, but that's the difference between an equity loan and an equity line. You want to know more? Maybe you need one. Maybe you need one of those items. Give us a call. It's 844-935-3634. That's 844, we lend for you. WELEND and the number 4. All right, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom. And you're yelling at, why are you wagging at me? You guys can tell we are live right now and we are trying to figure out what we're doing. So give us a minute. There we go. Let's see if that works. All right. He's getting there, man. He's getting us there. So welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom. This is actually a new program that we are using. Usually I use Zoom, but Zoom cuts us off early at 30 minutes. And so we're trying this one to see if it was better sound and more clear picture and everything about it. But we're having a little bit of computer problems today, so bear with us. Apparently, even during the commercials and the opening, usually that's all muted out, so I can talk all I want. And I guess you guys were able to hear me, so that's even funnier. Absolutely love it. But we are here. We are with George Hartman, and I don't want to go anywhere until we get through the 5 points that I want you guys to hear. So 5 very important tips, tricks, and information that you need all about getting your credit score as high as possible. So this is all coming directly from George. I had him write it all down so that I could print it and look like the expert. So I am going to read it to you guys, and then I'm going to let George elaborate a little bit, but I want to make sure I get these out to everybody that will hear the show, even my Saturday 30-minute listeners. So here we go. So number 1, most important thing, on-time payments. On-time payments are crucial to building a strong credit profile. 30-day late payments hurt your credit scores by 60 to 80 points. They take a full 24 months to recover the full credit score. They are also exceedingly difficult removals. Never make a payment past 30 days from the due date. So we did talk about this a little bit earlier in the show, but I'm going to let you elaborate on that, George. So one more time, give it to them so they understand how important that it is.
Yeah, to build up to the 750, 800 and the long term, the history of what they're looking for is on-time payments, not past 30 days late. If you need to make it late here and there and you pay the fee, that's okay. But if it goes past 30 days, it's a tough removal. It's a 24-month recovery time, and even longer than that for them to really see those super high credit scores. So, put them on auto pay as much as you can and just don't miss those payments.
All right. I love it. I also want to say that because we're talking removals, that is what George does. George is a credit repair company. He owns a credit repair company. So we are going to talk about George at the end in case you are interested in taking on, his services. He is definitely here to provide a service to help you. There are some people that, they're don't know how to get started. They don't know how to clean up their credit themselves, and they really need that help. And so we're going to talk about how you get in touch with George and how he helps you to get some things cleaned up on that credit report. All right. So number 2, revolving accounts and balances. Credit card balances equate to 35% of your credit scores. Any balance over 20% of the limit starts to lower the scores. Having 3 to 5 open credit lines is ideal. If you don't have enough accounts or a credit card, see tip below. So I just want you to reiterate how important it is to have those credit scores, those balances low to the credit lines, and how many accounts, and why don't you give us the tip?
Yeah, I tell you what, 3 to 5 accounts, under 20% of the limits. As soon as it goes over 20%, you're going to see your scores start to plummet. Be very careful of small limit credit cards, especially as you're rebuilding your credit and only getting a $300 or $500 card. You could go to Costco and max it out with one shopping spree. So you've got to be very, very careful with those. And my tip to get 3 to 5, right? How do I get credit? Is an authorized user account is always one of the best strategies to help somebody to build their credit. And that's just like a husband adding his wife to a card. Or, I did it with a friend of mine when I was rebuilding mine. He added me to 2 of his credit cards that he had for 10 years with zero balance with $10,000 limits. And that history landed on my account. So when that came into my credit scores went up almost 100 points.
Yeah.
So the authorized user is a great one.
Yes, it is. We love authorized users. We actually talk about that quite often during those consults. When we're pulling somebody's credit report, or we're talking to them about their credit scores and what can we do to try to get them maybe into the next loan option or program available. And we talk about adding somebody as an authorized user. So if you're someone that doesn't have a lot of credit and you want to know a little bit more about that, please feel free to call the office. We're here to help. All right. Number 3, you ready? Inquiries. Hard inquiries versus soft inquiries. What's the difference? So we did just kind of go over that because that's what Michael had asked us about, the soft inquiry. But it says consumer credit reports like Experian.com, Credit Karma, and the site we use at georgehartman.com are considered soft credit pulls. If you are applying to acquire anything tangible that would normally be a hard credit pull, hard credit pulls lower your credit scores. So what I do want you to talk about is we have a lot of people that get worried. They've talked to another lender and they already had their credit report pulled, and then they talk with their real estate agent. They're not really getting along with the lender that they started with, or they're not getting the answers that they need. Their real estate agent saying, hey, you really need to call our girls over here. They call us up and they get really worried about having their credit report pulled again. So why don't you talk a little bit about, if you're shopping for a car loan, you're shopping for a mortgage loan, how many inquiries can you have? How many should you have within 4 years if they're different credit types? So I'm going to let you jump into those inquiries here for a minute.
Yeah, they're really they don't give you a lot. Like 3 to 5 hard inquiries a year is what kind of where they're at. Now, when you're shopping for something, unfortunately, none of us read the fine print, right? Especially when it comes to an automobile. You go in, you fill out the application, and unfortunately, by not reading that, it does say in there that they will shop you for the best interest rate. So typically, if you're an 800 credit score, you come in, you get the A+ paper. They only run your credit once, and you qualify and you get the best rate. But for those of us that have gone through life at a 680 or a 650 or, I've got a good enough credit score, they're going to shop you. So they'll go to their prime company first. And if they don't get the program, then they're going to run it again at the next company. And they might run it up to 10 times before they find a program that will actually buy you. Now, for your protection, any multiple credit inquiries within a 30-day period for the same type of purchase really counts as a single hit to your credit.
Correct. So we have people that have started with another lender that call us a week later and say, we really told to call you. I was talking to my friend about buying a house and she said, I had to use you, but I've already had my credit report pulled. And so I always explain to them that, yes, you're going to see the other lender's credit inquiry on the credit report. You're going to see my inquiry on the credit report. It will be there. You're going to, another lender pulls your credit. They're going to know who's pulled. But the actual hit to the credit score happens from the very first lender that pulled it. As long as you are shopping mortgage company, you can have that credit report pulled multiple times within that 30-day period. I like to tell people to try to get it done within about 2 to 3 weeks because I like to be a little bit, a little less time than what they actually tell you that they'll give you because gosh, if you did like 31 days and then all of a sudden the credit score drops again because it's a fresh inquiry, we don't want that.
Yeah.
But the same goes for, a car loan. Now, I don't know what the answer is to a credit card, in all honesty. I don't know if you're applying for a credit card and then you go apply for another credit card and you go apply for another credit card. I don't know if that accounts for shopping for the same thing. Do you know the answer to that?
I've seen it over the years where it definitely will be like an individual another hit for each credit card, because those are totally different entities. Even though they're for the same thing, you're applying at a different entity, which it does affect you differently than the car or the mortgage.
Right. So you want to avoid that. You do not want to apply for multiple credit cards at the same time. So one thing I do need to say is that we are actually at the end of our 30 minutes. We are not going to have enough time for my Go Country listeners to hear our number 4 and 5 points. But if you are enjoying the show, you are liking what you're hearing, you want to hear the rest of these tips that George has got for us today, jump on over to YouTube, go look up Mortgage Mom Radio, and the most recent show is there for you guys. Just go to the live. There's actually, different folders. Go to live and you'll see the most recent show and you'll see me and George. And then you guys can even jump towards the end where you know that you left off right about 30 minutes so that you can hear the rest of what we're saying. For George, for those listeners on radio, I'm going to read out your telephone number and your website. So it is George Hartman, and he spells that with 2 N's, Hartman, Hartmann, and he is 805-432-6772. And his website is Credit Repair in 30, and the 30 is 30. It is not spelled out. So creditrepairin30.com. If you guys want to talk directly with George, get yourself a consultation with him and see what he can do to maybe help you to get that credit score and that credit repair started for you to be able to buy a house in 2024 or refi or solar or whatever it is that you guys might need. So thank you so much for joining and listening today on Go Country 105. But for my YouTube listeners, we are not done. So let's keep going. All right. So number 4, credit scores. The algorithm is different for each sector in calculating credit worthiness and risk. Example, consumer, auto, mortgage, solar, etc. So I'm going to let you elaborate on credit scores. Why are they all different?
It's one of the most asked questions and one of the most confusing questions. And I've been doing this for 12 years and it's confusing. And I did mortgages for 10 years before the 12 years. So, it's something that always confuses people. And, what you want to take a look at is you have consumer scores, which is what a lot of people are used to most because that's what they're seeing on Credit Karma, Experian.com, Identity IQ. All of the consumer sites are, they're very generous, let me say, like 20 to 50 points it could be as far as their credit score. So now the credit is the same. Everything that they're reporting is the same. The other thing that can make scores different is certain creditors only report to one bureau or 2 bureaus, and it doesn't show up on all 3 bureaus. So that can make the scores a little different. And then mostly, the easiest way to explain it is if you apply for a credit card in the morning, an automobile at lunch, and a mortgage at dinner, all the scores are going to be different. And it's all based on an algorithm that is risk-based based on that particular sector.
Right. So a mortgage is going to be factoring your credit score or looking at your credit report and factoring what the score is that they determine it to be based on certain attributes for somebody that's trying to get approved for a mortgage versus something that the auto loan is going to be looking at different attributes on that credit report, and they're going to get a different credit score back for that sector, like George is saying. So just realize that your consumer credit score, that the number that you see when you log into your Capital One or you log into your Discover or your American Express or whatever, card that is that says, would you like to see you have an update to your credit score, and it shows you your credit score. Realize that that is not the credit score that you are going to see when you apply for a mortgage, when you apply for a credit card, when you apply for a car loan. It's going to be different based on what you're applying for. So that was great, George. I appreciate that you brought that one up because I get that all the time. We pull somebody's credit report, their credit score is different than what they're used to seeing, and boy, do they get upset. And it's not us. I don't get to determine what your credit score is. If I did, everybody would have an 850 and we'd be giving everybody a loan. So it's not up to me. I don't determine what that credit score is, but it can be a big shock factor, and it really does upset people because they, like you, really have that drive to have the highest credit score that they can, and they almost get addicted to making sure that everything's paid almost like way too early. And it's just once you really get to that part where you really have that confidence and that excitement about who you are and what your credit report looks like, then it really does kind of become an addiction. And so they can get so angry and so upset, and they just have to realize that it's the scores are based on different things and algorithms based on what you're applying for. So it is different than what you see on your consumer score. All right, number 5, derogatory credit, collections, and charge-offs. All derogatory credit can and should be disputed for accuracy before settling any accounts. Typically, verified debts can be settled for approximately 50%. Once settled, they can be redisputed for removal. So I'm going to let you talk about that because this is where you come in, and this is where your expertise helps those that need maybe a little bit of help with their credit report.
Yeah, derogatory credit. The one thing is pretty much, it's kind of interesting. 98% of my clients, the derogatory credit is their credit. It's the mistakes that we made, or not even mistakes, but life happens, as one of our listeners said, right? And that was me. That was me in 2007. Life happened. And by 2009, my credit was in in the garbage, and I had to start from scratch. And I had to learn all of these things. And the derogatory credit that came up, I was taught right there. They said, never pay something until it's verified. And you want to verify that it's true and correct because there's so many mistakes on the credit bureaus, and you want to make sure you're not paying something that's not verified. Now, typically, if a debt is verified, they're going to be in a couple of different stages. They could be in a charge-off situation, or eventually, if it sits long enough, it goes to collection. And it's kind of strange, but the items that are in collection can sometimes be better negotiated and removed off a credit report better, faster, and easier than a charge-off that is with an original lender. Now, once they do get verified, typically most of those can be settled for about 50 cents on the dollar, which they will need to be settled to move your credit forward. I help you with the information that you need to negotiate them. You don't need to pay anybody to do these negotiations. They're super, super easy, and I work with you on that. But it is the process that you need to go through to settle it, get it to zero balance, to eventually have a chance to get it removed from the credit report.
Now, one thing that I do want to go back to, and it was something that we talked about at the beginning when we got the question from Michael, where he was it wasn't. I think it was, who was it? It was, I got to go back now. It was Annette. And Annette had asked about getting the personal loan to pay off the credit cards, and would that hurt her credit score and everything. And we kind of started to roll into debt consolidation. And by that, what I'm talking about is not going out and getting yourself a loan to pay off what you owe, having a loan that you now owe and making payments on that loan. So you're taking full responsibility for every dollar that you used, and you are paying everything back responsibly. That is not what we are talking about. We are talking about debt relief, is what they'll call it sometimes. But there are companies out there that will say they're going to advertise it as debt consolidation. You don't have to get a loan. We're going to give you debt relief. Sometimes they call it consumer credit counseling. So I do want to talk about that because we have had quite a few clients here very, very recently that signed up for this because, let's face it, things have been expensive. Inflation was through the roof. Eggs were $15 a carton for a minute. Gas has been astronomical, right? So everybody has definitely found themselves using more credit cards and living a little bit more paycheck to paycheck over these last, couple of years. And so we've had more people that have gone to that thinking that that was the solution, and they are just an absolute downright mess right now. So I do want you to talk a little bit about that, George, about the debt relief, credit consumer counseling, debt consolidation. If you are not signing up for a loan, they are not pulling your credit report to give you that loan, then you are not looking at a actual debt consolidation loan. You are looking at something totally different. So let's talk about what that is.
Yeah, because most people's debts are not in a place yet. Some people are still making their payments and they still, have good credit. But typically those companies are going to allow your debts to go late. In fact, they advise you to just stop making your payments. So immediately you're going to have the late payments on your credit report. Then you're going to have the charge off on your credit report. And eventually you might not have you're not going to have the collection because that company will settle. They're going to settle your debt for less than what you owe, which is going to turn into a collection or a charge off on your report, but saying that you have a lower monthly payment, but they settled the debt for you. It's something that you could do on your own and just have that negative debt on your credit because it's going to be there anyway.
Right. So here's the thing. This is what I hate about that whole situation is that you are signing up, you are making a payment monthly, you are sending that payment to this company. You think that what you're doing is making a loan payment towards all of your debts, when in reality what they're doing is they're collecting your monthly payment every month and they're putting it into an account with your name on it. It's your money, but they're putting that money into your account and they're just collecting it and collecting it and collecting it. They're not making a payment on a single debt. So all of your credit cards are going 30 days, 60 day, 90 day, 120 day, charge off, right? And so let's go back to what George said at the very beginning of this show. 1 30-day late changes your credit score by how many points, George?
60 to 100.
Okay. So now you've got pay, and that's a 30-day late. So what does a 60-day late do to you, George?
Yeah, it rolls about the same. So the 30, the 60, the 90, it's going to roll about the same. The hit is so extreme on the 30 that they remain about the same until you can catch it up and start to recoup the score.
Right. So you've got, now you've got multiple accounts with multiple late payments. You had a credit score that was maybe 660, 670 before that, that would be somebody that's pretty maxed out in what their credit card balances are to what their limits are. So you'll see those credit scores kind of be in that 660, 670 range. All their payments have been made on time, but they're struggling. They're kind of tapped out on the debt. And then all of a sudden they go from like a 660, 670, and now they're, down in the 450s, 500s, 520s, right? And it's just night and day. And then the hole that you just dug for yourself, to dig yourself out of that hole, even if you settle all of that debt and you pay all that debt off, even if it is at 50% of what you owed. So you got a deal, you paid it off for less than what you had spent, right? But how long is it truly going to take to dig yourself out of that hole? Like, now we've got to get new credit, and we've got to start to build new credit, and we've got to make payments on time. For how long, George?
They look for 3 to 6 months minimum, up to a year sometimes, that they're one on-time current payments, and then 2 years before those late payments are not affecting you at all.
Right. So it's going to take you 2 years, but you've also got to rebuild, and then you need to have those accounts open and those payments being made on time, right? It could be at literally years before you see your credit score get back to where it was before you stopped making those payments. So ultimately, there are people that are out there that are just so tapped out. It is the only option. And I am not looking down on you for that option. It is certainly there because there are people that need it. And it is an option of something that you could do. What George is saying is you can actually do that option all on your own. You don't need some company to do it for you. But if you can avoid that scenario at all by any means possible, you absolutely want to avoid that scenario, because you have no idea how long it is going to take you to dig out of that hole and get back to where you were before you made the decision to start letting things go.
Yeah, for sure. And that in my complimentary, we look at your credit report. We do a complimentary consultation, a full analysis, send that to you before you ever move forward on a credit repair or a credit education, to make sure that you know exactly where you stand. So if you're in that position where you're not quite sure what to do, it's another reason to come, have a complete analysis done, get some advice on which direction that you should go.
Yeah, absolutely. So let's see if we've got any more comments going on here. So Michael says, thank you so much for explaining that. So that was back at his question about soft inquiry. Sandra jumps on and says, hi, Debbie, Sandra here. Sandra, so great to see you. And another girl, her name is Me B. So I've never seen you jump on with us before. Thank you so much for watching. She gives us the clapping hands. So I love it when I can see the people that are watching the show, that are tuning in, that are getting the education. We love that. And we want you guys to call George if you do find that you're in a situation where you need to do something. Your credit's either already there and it's kind of messed up and you want to figure out what can you do to clean it up and repair it. We want you to call George. If you are thinking about maybe letting things, you think about starting to let things go, maybe call George and talk about that before you do it. Let's see if there's some other way around it. If you're a homeowner, you've got a lot of equity in your home and you do have debt that you need to get paid off. I can't promise that we can do a loan for every single person. Everybody has different income. So for example, if you have good income, documentable income, your credit is good, there's nothing late, there's nothing derogatory, the income is sufficient to be able to do a loan to pay debt off, that's a great opportunity for a home equity line, home equity loan, a full-blown refinance. But if you can't verify your income or your debt is just so much that your income's not enough to support a loan, then that's a different story. So I can't promise that we can do a loan for every single person that is out there. But if you are a homeowner, the chances of you having equity in your property right now are very, very good, very, very high with all of the appreciation that everybody has gained in their property values over the recent years. And so before you would just stop making payments on debt, before you would just start letting your credit report go, before you'd start thinking about something like a bankruptcy, give us a call and at least talk to us, and let's see if there isn't an option there for something, some sort of a debt consolidation that we can do to try to help you get those debts paid off. And then even further from there, before, even if we say, all right, look at no, we can't do it for you, give George a call, talk to George and see what George's thought process is and if he's got any ideas before you just stop making payments on things. So we're going to do this one more time, George. So it is georgehartman.com. So it's HARTMANN, so 2 N's, georgehartman.com. Or you can go to the creditrepair.in30.com, and 30 is the 30. And his telephone number is 805-432-6772. So, George, thank you so much for being on today. This was a great show. We covered so many great topics. Is there anything that you want to throw out that we didn't get to before we do shut it off?
The only thing I want to share is I want to share one quick story, because this example will just show you on a massive scale over a lifetime how many mistakes we can make and what a joy it is when your credit's in the best shape. It took me a long time to rebuild my credit, getting it back up to the 790s. But the fact that I knew everything that was going on with every account, I went to buy an RV. And typically you'd walk on the lot, you find something, you say, okay, run my credit. Let me see if I qualify, that type of thing. But I found the right RV, but I knew that I had used one of my credit cards and I had put $298 on a $300 credit card. Now, for some reason, the bureaus were reading that as 98% of my credit was being used. Now, I had a bunch of other credit cards, which typically they go off all of them. But they were making a mistake, like the millions of mistakes that they make. So I told the guy, I said, hey, give me a quote based on my current credit score at 711, because it dropped to 711 from the high 700s, just because one little credit card doing a meeting for some realtors in Pismo Beach.
Right.
And so I told him, he said, okay, you're going to need 10% down, and it was going to be a 5.4% interest rate. And I said, okay, no problem. I'll call you in 10 days when I know my credit card post to zero balance. So long story short, 10 days later, I was in control of my purchase. And I said, okay, it's time to run my credit. Go ahead. 791 came in and they said, Mr. Hartman, would you like your $500 back? And your interest rate will be 249.
Right. Huge difference, right?
There was no difference. So it saved me approximately $10,000 out of pocket. And what do you think it would have saved me over a 15-year loan going from 249 to a 5+?
Right.
So there was no argument. There was no negotiating. They had to give me A+ paper. And imagine that on every transaction over your lifetime, that you're in control of each one of those purchases. So give me a call. We can go over it. Can help you guys get educated, educate your families, and get your credit cleaned up in the meantime.
I love it. Well, thank you so much, George, for being here once again. Thank you for all of you that have been listening to the show. I don't see any more questions that have come in through the feed, so we are going to shut it off for today, but we will be back again next Wednesday right here on YouTube, 1 p.m. Pacific time. This is when we go live. If you want to make sure that you do not miss the show, get your text message with the link to join. How do you do that? You text the word MOM to 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. If you're ready to get your exciting 2024 started with that new purchase or with that refinance, go to our website, go to mortgagemomradio.com. You can get our information there as well. It's the same phone number to call the office that you would text the word MOM. We are easy to find and we are looking to help you guys when you are ready. So thank you again. We'll be here next Wednesday. George, thank you. You've been lovely, and we'll talk to you guys all real soon. Bye-bye.
Thanks, guys.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.